Imagine booking a revenue backlog of basically $100 billion and the market responds by nuking your stock 15% the very second you open your mouth on the earnings call. Welcome to Earnings Unscripted. Today is May 7th, 2026, and we are looking at first quarter numbers for the AI cloud infrastructure giant CoreWeave, ticker CRWV. Miro, the tape reaction here was, honestly, it was pretty violent.
Yeah, it was an absolute cliff dive. The thing is, if you look at the raw growth, it actually looks fantastic. Revenue came in at $2.1 billion for the quarter, which is up 32% sequentially. The problem is they swung to a net loss of $740 million, and the adjusted operating margin crashed down to a trough of just 1%.
Right. And just as a quick sanity check for everyone listening, we are just two people analyzing earnings. So this is all our personal opinion and absolutely not financial advice, just in case anyone thought about panic selling based on a 1% margin print.
Yeah, I definitely would not recommend that. But algorithm traders completely hated that 1% number. The stock was actually relatively stable in extended hours, around $128. But literally at 5 p.m. Eastern, right when the call kicked off, the floor just fell out. Shares went near vertical into the red, bottoming out around $115. It ended up being a sharp 15.28% drop from the previous day's close.
Which is, it is just wild. CoreWeave basically rents out massive localized compute power for artificial intelligence. So demand is literally everywhere. Their contracted revenue backlog just exploded by almost 64% to $99.4 billion. So why the sudden panic over profitability?
It is entirely a timing mismatch. The CEO mentioned they surpassed 1 gigawatt of active power, but they are expanding so fast that they actually secured another 400 megawatts of infrastructure just this past quarter.
Wow!
Exactly. When you operate at that gargantuan scale, you start paying the power and lease costs immediately, but it still takes 1 or 2 months to actually finish the physical data center fit out and flip the switch for the customer. So they're eating all the operational expense of these massive deployments weeks before any of the revenue actually starts flowing.
Got it. So the margin hit is artificial. They're essentially victims of their own rapid growth velocity. And what they're building actually changes physical realities for people. Like, they highlighted a customer called Advaita Bio on the call. They used CoreWeave's unified cloud architecture for single-cell biology analysis, and it literally compressed calculations that used to take weeks of computing time into just minutes. So this is not just server farms sitting idle. This is, real-world acceleration.
No, that is exactly the issue people miss. It's being heavily utilized. In fact, over 50% of CoreWeave's compute is now actively being used for inference workloads rather than just model training. People are finally generating actual revenue from end users, so the monetization phase has definitely arrived.
That proves out so much of the whole AI ROI narrative right there. All right, let's get into the details on who exactly is driving this massive demand and taking up all these new contracts.
Well, it is actually shifting away from the people you would expect. The foundational AI labs are shrinking as a piece of the pie. They are down to less than 30% of that overall backlog now.
Wait, less than 30? That is a huge drop. Who's replacing them then?
Wall Street. The quantitative trading firms are basically pulling up a seat and taking over. Just to give you an idea, Jane Street alone just added $6 billion in capacity to the backlog.
Okay, $6 billion for one quant firm. That is just wild. But honestly, it makes total sense because they're already sitting on mountains of cash. They're not out there burning through venture funding, just hoping a model works out eventually.
Exactly. The credit risk is completely different. And that's the underlying trick here. Because CoreWeave has these highly profitable investment-grade customers now, they can completely restructure how they borrow money. Which brings us to the really interesting part of this whole quarter. I think this is the real story.
Right. The debt facility. Let me check the notes. The delayed draw term loan.
Yeah, DDTL 4.0 to be specific. They raised $8.5 billion, and they secured it at a sub-6% interest rate, which is just, for context, that is basically unheard of for a cloud infrastructure startup.
No, but that is exactly why people misunderstand them. They are not borrowing like a software startup anymore. They're borrowing like an airline or a shipping company. The CEO actually said on the call, quote, "This is the first ever investment grade delayed draw term loan backed by HPC infrastructure." They got an A- equivalent rating.
So they literally convinced Wall Street to treat NVIDIA GPUs like hard physical real estate.
It is a total structural shift in the economics of the space. You basically take the risk of building AI data centers and standardize it. And it lets them solve their biggest problem, which surprisingly is not securing the chips. The CEO flat out said they can secure infrastructure at gargantuan scale, independent of any support from NVIDIA or anyone else.
Okay, yes, but if chips are not the bottleneck, and money is apparently cheap for them now, what is actually stopping them from growing even faster? Because $99 billion in backlog has to live somewhere physically.
Right, so you hit the wall of physical reality. The gating item is no longer power or GPUs, it's labor, it's memory, it's storage and networking. You have this massive influx of core compute, but you still need, actual humans with wrenches to plug in the memory and route the cables.
The unglamorous stuff. You can buy all the GPUs on Earth, but if you can't find enough electricians to finish the fit out, the data center stays dark.
Pretty much. Component pricing inflation actually forced them to raise the low end of their full-year CapEx guidance, strictly because non-GPU components are getting squeezed. So they bumped that floor up from $30 billion to $31 billion.
Geez, a casual $1 billion rounding error for cables and RAM. But I guess they're insulated from that, right? They said they build their contracts to incorporate the cost of all components, so the price hikes just get passed through.
By and large, they are insulated, yeah, but it does show where the friction points are moving in the broader AI supply chain. The limit is the physical wrench time.
So then the obvious question becomes execution. They have the money, they have the demand, but they're fighting physics to get it built. Where does that actually leave them heading into the rest of the year?
Well, they basically told us, it leaves them right on schedule to climb out of that margin trough. They are guiding Q2 adjusted operating income up slightly, somewhere between $30 and $90 million. So that inflection point is officially happening.
Right. So that 1% margin from Q1 really was just the absolute bottom, which is exactly what management claimed.
Yeah, I think we can trust that piece. They actually reaffirmed the full-year operating income guide. But the real flex is they bumped the lower end of their exit revenue run rate for 2026, up to $18 billion now. I mean, they are clearly seeing the long-term demand lock in across these enterprise verticals.
Just casually raising the floor by an entire $1 billion. It really feels like they reached that, what did they call it, escape velocity?
Yeah.
Because at this massive scale, they are not really worrying about finding customers anymore.
No, not at all. It is strictly an execution game now. The CEO actually said on the call, the constraint in AI is no longer whether enterprises want to deploy. It is just how quickly reliable cloud capacity can be delivered. The demand risk is basically gone.
Exactly. And, we have pointed out the internal control weaknesses from their private days before. Operating at this speed usually breaks things internally, but standing up gigawatts of active power and pulling in these massive financial clients, you kind of have to give them credit here. They are literally building the next generation utility grid right in front of us.
You do. Look, I am usually the first one to call out aggressive leverage. Their Q2 interest expense alone is projected to hit something like $700 million just for one quarter. But if Wall Street is fully willing to treat your GPU clusters like safe, standardized real estate, you kind of have to play that hand to the absolute limit.
Yeah, it's definitely working for them so far. We'll just have to watch if the supply chain and human logistics can keep up with the financial engineering. All right, I think that's a wrap on CoreWeave for today. Thanks for thinking out loud with us, guys. See you after the next call.
Take care, everyone.
And hey, if you want these earnings deep dives to just quietly show up for you, it helps to give the show a follow wherever you listen. This whole podcast is actually an AI experiment designed to see if we can take 50-page financial PDFs and turn them into an actual human-sounding conversation. So we genuinely want to hear what you think. Feel free to drop us a ticker request at earningsunscripted@datamadness.com or just grab the X link down in the show notes.
Catch you next time.